The following is a presentation of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-445-1044. Now, Larry Pesavento.
Okay, looking good, Billy Ray. Feeling good, Lewis. From the offices of Duke & Duke, 100 South Broad Street, Philadelphia, Pesavento. This is Billy Ray Valentine, and we're going to talk about the Gartley pattern that we have staring us in the face in the Dow Jones Industrial Average, folks. If you like Fibonacci, and if you like Gartley, and if you like ABCD, well, it's all coming together here. In the words of that great cowboy poet, Will Rogers, politicians are like diapers. They should be changed often for the same reasons. And this is what we have going on right now. We got a diaper change going in the Dow Jones from buyers to sellers. They're going to be different fellers. If it goes up today, this week, above 17,000, you will find me at the 1600 South Broad Street McDonald's working as a fry cook in Philadelphia, Pennsylvania. If it goes down, I might stay here at the offices of Duke & Duke for a little bit longer. We'll have to just wait and see how the markets end up for the week. But this is really a nice pattern that we have going here in the Dow Jones Industrial Average. We're going to have Bill Koval on the tube tonight, or this morning. Folks, I have been up. I did a webinar in London this morning for a friend of mine, and got to be a little bit longer than I had hoped. But a lot of good people, had a lot of fun, but it was in the middle of the night, so I'm a little bit tired. So after today's show, I'm going to take a little break. We're going to look at the New York Stock Exchange Index now. It gives a little bit better picture of what we're looking at here, because if you can see this one, we're also at a 61% retracement of the November high. Now, the difference that we saw from the Dow Jones chart and this chart that we're looking at right here is the Dow Jones was making a retracement of 61% on the whole move down from November the 19th. So this is a very different situation. Stocks are actually much weaker in the New York Stock Exchange Index than they are in the rest of the market. But that's been going on, for quite some time. If you'll notice this double bottom that we had, which was an ABCD pattern, we've also now completed the ABCD structure to the upside at the 61% retracement, and that also was a Gartley. So we had two major Gartleys here at the same time in both the Dow Jones and also in the New York Stock Exchange Index. If we take a look at the let's try to get my words together so I don't slur them. Hold on just a second. Now we're going to take a look at the NASDAQ. And as you can see, the NASDAQ has not made a 61% retracement back from the highs that were made back in December, nor has it structured a ABCD pattern in here. What's interesting is with the stock market up Wednesday, Thursday, and Friday of last week, the NASDAQ was actually lower on those 3 days. It's very important for several reasons. One, it was acting much weaker than the market, and it had been the strongest, as we've noticed all along, because we topped in May in the regular stock market, but the NASDAQ did not top until right around Thanksgiving. So it topped a lot later. Now it's been much, much weaker, and it continues, to show this weakness. The other reason why it's important is we know from statistics the last 2 days of the month and the first 2 days of the month are the most positive days for the market to close higher. Those are just statistics that have been with the market ever since modern times, which anytime after the big war, World War II, we have those statistics in our favor. So that's another sign that the market is weakening a little bit. We'll have to see what's going to happen with it before it's all over. But we want to look at one other, and that, of course, is the S&P 500. This is very similar to what's going on in the futures also, because we did get up to this 2000 level. We hit 2007 in the futures, and now we are making another Gartley at the 61% retracement of the high from November, which would be the exact 61% retracement from the high in May. So we have two major Gartley patterns here. One in October led to a big move down, and now we have another one that is at a much lower level. And so you have those lower tops, which is another 135 pattern. We have a 1 at point A, we have a 3 at point C, and we have a 0.5 as of Friday. That's very similar to the 135 pattern that's listed on this chart that we had in late December, and of course it culminated on January 4th with the big move down. So the whole setup is ready to go lower. I mean, you just like when God opens a door, he probably leaves a couple of windows open too. I don't know, but this is a screaming major sell. The only thing that's going to change it is if we turn and get a lot stronger. There's always that possibility, of course, because we do have a new moon and a solar eclipse starting tomorrow. It proceeds through Wednesday. As Arch Crawford mentioned, who was our guest last week, solar eclipses are not very good at predicting stuff in the stock market. Lunar eclipses certainly are. And we have one of those on the 24th, I believe, but we don't have anything right now with the astrology part other than that new moon and solar eclipse. We've got a Bradley date coming up. What am I talking about? We've got a Bradley date on the 8th, so that's tomorrow also. That's within a window of 1 or 2 days, so we could be close. The second thing I wanted to mention about this S&P chart, and I just lost my train of thought. What was it? Oh, dear. Oh, as a point of trivia, you're not going to believe this, folks. Do you know I was born the same time that Ralph Elliott, the Elliott Wave dude, was born, July 28th. We had the same birth date. I have to tell Arch Crawford that because he's born on the same date that J.P. Morgan, which is much more bigger than the old Ralph Elliott. So, and also we would have been the same age. So if I make it to January, we'll both have made it to the same age, which is going to be interesting too. And one other. Two pieces of trivia about Elliott Wave that it just absolutely blows my mind. When I was a little boy in Terre Haute, Indiana, we only had a 3-digit. We had what they called the party lines. There were like 7 or 8 people or more on our line. We shared a line with a neighbor, and our phone number, I'll never forget it. The phone number was Harrison 127, which was a fib number. And then when I moved to California in 1965, before I knew anything about Fibonacci, I didn't know anything about that till 1970, my phone number was 889-1618. And boy, if that's not some type of karma, I don't know. But that's what happened. So we'll wait and see. The Bradley turn date is actually March the 10th or 11th, based on what we really should be looking at. That's the work of our good friend, Norm Winsky, because he's got some really great stuff from Astro Trend. 877-927-6648.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile based scanner in the industry, powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and I have posted into the Tiger TV one of the most bearish charts that you could possibly look at. This is the biotech index. This had been the big daddy rabbit that ran this market so high up, both, part of the fact of this, a lot of these stocks are in the NASDAQ, but look at it now, where you talk about a dying quail. We bottomed on the 10th of February when we had that big bottom where we returned on the Dow rallied well over 1,000 points. But look at how bearish it is, folks. I mean, it is it can't even bounce at all. This is one bearish index. It might change overnight and get really bullish, but boy, the way it looks now, it can't get any more bearish than this. I mean, it just has no oomph to the upside at all. That's not a very good sign. If you look at any chart, maybe it's lagging, I don't know. But when you look at this chart, boy, it's really hard to be bullish, this one. So be really careful if you're in some of these biotechs. I don't look at them very often. I don't look at them at all. What am I talking about? Very often. But it doesn't look like it wants to rally very much at all. By the way, at the break here, we're going to have Bill Koval of WDK Analytics on, and we'll certainly be able to look at that. I've had a request to confirm the Bradley dates. It is the 10th. Now, the Bradley date can be anywhere. It's got to be close to the 9th, because the 8th, 9th is the solar eclipse and new moon. That's included in that Bradley. So it's got to be within that ballpark. One other thing, folks, if you get up early in the morning, and most of us do, and you look to the east where the new moon is going to be, You'll have to look closely because it's dark, but you'll see a very, very bright star right next to the to the moon, and that is Jupiter. It's making a opposition to the sun, so it's going to be incredibly bright, and you want to keep an eye on that because it's really shining very, very bright. It's actually very beautiful, and when you see it, and when we have the morning star, which is Venus, you really get a really big idea of what's happening with it. Now, if Mercury were to line up with Venus, which that would be combust, that's not happening. You'd really see, a lot of stars all lined up together. It makes it very, very bright. So we'll watch that. But Jupiter is really beautiful. If you have binoculars, you can probably see, some of the outlines of the moon. And of course, with the eclipse coming, you certainly don't want to look at an eclipse with with your binoculars or anything, but you'll watch it on TV and you can see it on NASA's site. It's really going to be a spectacular eclipse, so keep an eye on that. It's not the super thing like what we had on September the 27th, where we had the big bottom. That was a super full moon that we don't see very often, but this is going to be a new moon solar eclipse. The big one is the lunar eclipse on the 24th. That's the one that will be a bigger factor in the market than any of the other ones that we have. Now, I wanted to answer a question someone asked about the foreign exchange. Ask about the emerging markets, because we've heard how they've turned very, very, very bullish. And all I'm showing you here is the going back almost 9 months now. You'll see it's been in a really strong downtrend. We've had two major Gartley patterns. We had one finishing on October 19th, where the market went down and made new lows at a 1.618 expansion. And then, of course, we just completed another ABCD pattern at a 61% retracement. So this is not, this is just a rally in a bear market. That's what it looks like to me. Now, if we're really strong this week, then we're going to see what happens. Uh-oh, we've got a special guest, boys and girls. 3 wishes, who could it be? Priceline Charlie, La Paz, Mexico. Are you there, Charlie?
Yes, I am. Good morning, Larry.
Good morning to you, my friend. How are you today?
I'm doing well today.
Good. What can we help you with?
On Priceline.
Yes.
I think you made a very good call at 1276, I think. And,
well, we'll see.
Okay, I'll tell you what I know a little bit. Mind you, I don't consider myself an expert in anything but listening. And I try to listen well. But I was going through the Priceline chart, and I like the long-term charts because to me they present special opportunities. If you look at a monthly on Priceline, you will see that in 2009, it was selling for $200.
Oh, boy.
Today, 7 years later, it's $1,200.
Mm-hmm.
So what I do is, like we do the average, only like a 9-month average. The 9-month average on Priceline was also about $1,200, but the 50-month average is at $1,000. It hit it right on the money, just under $1,000.
Mm-hmm.
Bounced off it. Pretty much to the number you said. You said 1275. It hit 1300. That number, it's the same number.
Mm-hmm.
And I looked at the MACD, and when the MACD, the red crosses the blue, I always consider it a sell signal.
Mm-hmm.
So it has a solid red on top. Then when I looked at the relative strength, in 2014, it had a strength of 80, and that to me is an overbought condition.
Mm-hmm.
And that's why at that time, about a year ago, I said to myself, it's time to short Priceline. Didn't hit it exactly in the top, but that was pretty close. Well, I looked at it now, when the MACD is right on top, to me, long term, this is a sell. And the fact that we went down to 1,000, bounced off, the number that you gave, 1200, I think is a great, 1275 is a great number to short it, because when I looked at a different time period, like the weekly, okay, I noticed a very similar chart, okay? On the weekly, what it did was it went down to 1,000, but the 1,000 or the 950, so was the 200-day moving average. And on the long term, we bounced over, and the MACD had the same picture, red on top, blue on the bottom, and that to me indicated that it's a sell. But I also noticed that just this last week, the blue touched the red, and whenever I see that, I call that a retest. So retest it, and the moment of truth is this week. If it falls below 1,300 and continues heading to 1,200, I think this will tell us that this is really a good short. And just like you mentioned, the biotechs are in the disaster zone. Many of the high flyers are in a disaster zone right now. I think they're all going to be coming down. So I thought, what's your opinion on that matter?
I have to agree with you, Charlie. I mean, on all those things, especially the fact that the biotechs are so weak and the NASDAQ is very weak. So that's it. We got a commercial to pay for, my friend. Can you stay with us for just a little bit longer?
Yes, I'll stay for a minute.
Okay.
Yes.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks. We have Priceline Charlie from La Paz, Mexico, in the United States of America. Charlie, we're going to be watching Priceline very closely in here. I did post the chart in the den, and that 1275 to 1300 area looks like it should be some very strong resistance. So I will caution you, Charlie, if it gets above 1325, be very careful, because you know, that stock is not as well. I know it's pretty liquid, but it's not universally held like many others. So it always scares me when I see stocks like that. So just make sure you're careful.
Larry, I'm always careful in the stock market. It always seems to, you turn your back on it, it gets you. The other key point on a daily chart, the 200-day moving average is about 1250. If it breaks 1250 and heads down and then tests again, that means, and then it heads down again, that's the way I look at it, it's a short. I'm going to back up my truck, load it up with shorts on Priceline. So that's the way I'm looking at it.
Well, I'll be there with my tricycle, and I'll put a share on the back of my little three-wheeler, and off to the races we'll go.
Thank you very much.
Hey, listen, buddy, thanks for calling in, Charlie. We love to hear from you anytime, my friend, okay? And travel safe wherever you go.
You too. Thank you. Bye.
You bet. Okay, folks, I believe we have Bill Koval of WDK Analytics getting ready to join us here. Bill, are you there?
I sure am, Larry. Can you hear okay?
Just like you were next door, my friend. Hold on. I'm going to put your first chart up, which is your monthly chart with your bend the trend handle, and from WDK Analytics. Now, you want to explain to the folks what we're looking at on this chart? Because you're saying only the third time since the dot-com bubble has the percent of the 200-day moving average been at 90 or more, like it was on Friday. And I can see by those purple inserts that you have there that something big is happening. Do you want to go ahead and explain what it is?
Yeah, we'll cover that as long as you've got it up, and then I want to jump back to the 100-day as well. But as far as this monthly, what it's showing is how far really this bounce has come here in the last couple of weeks. It's actually achieved levels not seen since, well, the first one we encountered going back is in 2011, and then in 2009 as the market was coming off extreme lows. But outside of those three instances, I mean, you have to go back to .com to get to a point where the percent of issues that are trading above 90% above the 20-day average has occurred. So it's an extreme event, and as these things happen and work out, usually the market's going to, of course, roll over and pull back in, a little or a lot.
The question that I had, Bill, is I looked at those times of 2009, which was the major bottom. It was actually 7 years ago today, or tomorrow, that this bottom was made. I believe it was the 8th or 9th of March of 2009 was a major bottom. And then again, the one we had in July of 2011 that you're showing here, and we've got another one coming here now. What this could possibly mean, and I'm very bearish, but maybe this is just going to be a little bit of a pullback like those 2 years were, and then we could be going higher. I don't. Is that a possibility?
Well, it's always good to look at the other side, and certainly it is. But on the other chart, I've actually done some research and background on the 100-day as well as the 20-day, and I think I've got an explanation for why this is happening, and it's a little bit clearer when we look at the other chart. So if you want to put that up.
I see that now. Yes, much clearer. Okay, I've got that up for us, so take a look at it. This is the the weekly with the 100-day index on it. Is that correct?
Exactly. Yep.
Okay, why don't you explain to us this chart, because it looks very interesting.
So this one is more akin to those that we've seen over the years and the decades, where the internals of the market, decline prior to the indexes. The indexes are, of course, man-made constructs which don't always represent what's really going on in the market, and that's certainly typified by this comparison of the S&P to the percent of issues trading over their 100-day moving average. They've been declining since 2012, and whether it's percent issues above the 100-day or whether it's the advanced decline index, this relationship oftentimes entails in bull markets. Now, interestingly, since the 2 years since I've been doing my newsletter, I've actually got one of the reasons why this happens, and I'll explain briefly. And that is, I've been tracking the new highs and new lows since then, but with bar chart data, I can actually get a split on the new highs and new lows every day by time frame, 1 month, 3 months, 6 months, and a year. And also I can split it out by above $10 stocks and below $10. And the interesting thing is, up until in this latest bull market here that we've had in 2015, where it's topped out, the small caps have participated and sometimes led the larger caps, I'll call them. So in other words, the stocks above or stocks below $10 have oftentimes leaped ahead of or fallen behind the above $10 at peaks and valleys. Now, since November of 2015, and Tom DeMark has called November 3rd, the top in the market, and I've got momentum stuff that calls out November 3rd as well. But since that time, the stocks below $10 have really started to underperform those above $10. And my theory is that simply the smart money is they're done playing with those things by the time the market tops out, and they're worried about risk. So those are the ones that first get liquidated.
Now you would see that in the small cap index, the IWM.
Yeah, IWM. I track the Russell 2000 in the cash, and you can see that how that's deteriorated. Just a side note here. Last week, Zero Hedge called out from some analysts the difference in the Russell 2000 if you calculate the PE ratio with all the stocks or just the stocks that are making money. And it turns out that the runner of that index, which I think is ICE, maybe, that they calculated their PE ratio is 9, or actually 29.
Bill, we've got to take a little break here. Stay with us, and we'll be right back. We have to pay a few bills for Tom O'Brien, okay?
Sure.
Thank you.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives.
If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
It's 2016 and TFNN has a brand new programming lineup to kick things off. Starting January 4th, swim lessons by Thinkorswim and TD Ameritrade will be airing 5 days a week at noon Eastern Time. Join hosts Scott Connor, Kevin Hinks, and Cindy Faber as they host their daily options program live at noon 5 days a week with no commercials for the entire hour. Nico DeHaan and Paige Clark will be moving their program, Living a Primal Lifestyle, to twice a week, Tuesdays and Thursdays from 7 a.m. until 8 a.m. Eastern Time. Wake up with Nico and Paige and start your day off right. The Bull Bear Binary Option Hour by Nadex will now be live Mondays and Fridays at 10 a.m. Start and end the week with the three hosts, Tom O'Brien, Tommy O'Brien, and Daryl Martin as they break down the world of trading binary options and spreads. For all the details on the new 2016 programming lineup, visit the front page of TFNN.com. TFNN, educating investors. Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Direction's daily S&P Biotech 3 times bull and bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
The Bull Bear Binary Option Hour, sponsored by Nadex. Up next on TFNN.
Okay, folks, we have Bill Koval of WDK Analytics on the line, and he's talking to us about the number of stocks above the 200-day moving average and 100-day moving average. Bill, you want to go ahead and continue, please?
Yeah, two final points. One is I'll finish describing that Russell 2000 PE ratio, where if you calculate the PE based on only those stocks making money, you come up with something like a 29x ratio. But if you add them all in, which arguably perhaps should be done, the PE ratio is something like 290 times earnings. So quite elevated in a sense. The final point is this: that what that weekly or the monthly chart is showing, where we've in this last bounce we've leaked back up to the point where 90% of the issues are above their 20-day moving average. To my mind, that is coming on the back of a resumption in interest in small caps, and as typically happens, that happens when at tops in the market. So since last fall, the small caps have not been in the game compared to the large caps when it comes to new highs. They've trailed badly. Now, interestingly, just here on February 29th, according to my statistics, is the first time in nearly 2 years that the small cap new highs have been, the ratio has been above the large cap new high ratio by a factor of 2 to 1. I mean, that may have happened a long time in history, but this is the first time I'm showing that small caps have outperformed the large cap just on that one day.
Wow.
And furthermore, on the 3rd and 4th, last Thursday and Friday, the ratios for the large cap new highs are just, an insanely extended territory. Mm-hmm. And the small cap has participated, but the large cap is still by far, in front of the small cap in terms of new high and new low ratio. So in some, maybe this bounce is the start of something good. If you're a bull, I'm a little skeptical, frankly.
Mm-hmm. Well, I certainly am skeptical too for other reasons, of course, but the small cap, that's been one of the strongest of the seasonals, for them to gain on the large cap. Other than that one day, they've done very little. And when you look at that biotech index, Bill, that IBB, boy, that is one of the bearish chart I've seen in a very, very long time. That chart really looks sick. So
Yeah, right. I don't follow that as closely as you do, but I know anecdotally that it has been has been on the floor, so to speak.
Well, Bill, you got to stop using those big words like anecdotally. Man, I'm from Southern Indiana. We never hear words like that unless we're in the movies. So we'll have to keep it down here.
I'll dial it down a little bit, Larry.
Okay, that's good. Listen, I want to thank you for being on, and anytime that you feel like you need to share something of importance, like this certainly was, I'd like for you to keep in touch, and we'll have you on in another few weeks. At your, usually we try to get you on every few weeks because you're one of our more popular guests. So I wanted to thank you for coming on today. And again, if you see something interesting, please let me know.
Okay, Larry. Thank you, and I sure will.
Okay, thank you, folks. That was Bill. Oh, Bill, you still there?
Yes.
Let's give the information on how do you reach you. It's give them your email, please, and so how they can and your website. I know it's listed in there, but
wdkanalytics.com, and you can go to the newsletter tab and sign up for a free newsletter. You can go to the contact page and email me.
Okay, that's great. Well, listen, thank you again, and we'll talk to you soon, okay?
Great. Thanks, Larry. See you. Bye-bye.
You bet. That was Bill Koval of WDK Analytics. Now, I want to give everybody a free trip across the pond. We're going to go over to Asia to look at the Hang Seng Index because we're looking at the same, a big pattern in the Hang Seng. Today, we opened a little bit higher and then we closed a little bit lower. You can see the ABCD pattern that we have over the past month. And also we're coming into this, solar eclipse and new moon, mainly the new moon. The eclipse doesn't mean too much from what Arch Crawford had to say, and I have to agree with him. But we'll watch this very, very closely because this is also scheduled to come up. If you just did a normal time count on this Hang Seng, you can see that we had an 8-day rally going into the 22nd of February, and we're completing an 8-day rally as we speak today. So that should also be heading down. We've already looked at the emerging markets, and that certainly looks like it's very interesting. Now we're going to switch our little graph over here over to the gold market, and then we want to do crude oil also because got just a little time left. But you'll notice the gold, we've had these big rallies now since last December. We have the big rally. We've rallied $220 off the bottom. That's a huge rally. And we've made a little butterfly pattern up here on the last several weeks, as you can see, up around this 1280 level. So if we can pop above 1280 this week, this market this could be one of those king gold type trades where it just keeps going and going and going. I don't think that's going to happen because the silver just looks absolutely horrible when you compare it with the gold. I'm going to let you see how bad it really is. And it's hard for the gold to keep running without pulling silver along. Maybe it's an albatross, I don't know, but look at the difference in the gold and silver. If you go back to 2015 when we had that divergence, you'll see that was a major top in the market. And this time it's even worse. I mean, we haven't been above $16 in this whole rally. That's a very, very bad sign. So to me, I think this gold is a flat-out sale just because of looking at the silver. The same thing is true of the platinum. It's lagging very, very badly. So my assumption is that this rally in gold is maybe it's just starting, and we'll watch the pullbacks, of course, but I certainly can't chase it here, not with the pattern and the fact that we have this tremendous divergence in the silver and then also in the platinum. But I'd just be really careful being long these up in this area right here. That's the bottom line of looking at those particular ones. We're going to have, I guess, a break coming up pretty soon, but I do want to mention the chart of the crude oil, because we had this 3-drive pattern that we looked at. It was absolutely perfectly symmetrical, and now we've had the 3-8 rally, and we owe a lot of that to our good friend John Logan. His TAS profile was starting to pick this stuff up at around 29, and we've rallied up to almost 37. We've rallied almost $7 a barrel in the oil market in the face of the worst bearish news that any market could ever have. I mean, this is really every day. It just seems to be one more bearish thing to looking at what's going on. So I'm going to take a little break. 877-927-6648.
Hi, I'm Steve Rhodes, host of the Trader's Edge heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, folks, we're going to take a look now at, we had a couple of requests. The first was for Tesla. As you can see, Friday we hit the exact 61% retracement, coming in at the 204 level. We're trading a couple dollars under that right now. If Tesla's going to turn down, it's got to stay below 205, 206. And if it turns, then it could go a little bit higher. But right now it's certainly in a bear market. You've had lower highs, lower bottoms. I mean, this thing is certainly headed towards lower levels, in my opinion. And then finally, the last one that we have for the day is the CMG Chipotle Mexican Grill, the $529 taco stand. As you can see, we've got an ABCD Gartley at the 382 retracement from the big high that we made back up at 706 before we dropped all the way to 401 during their health problems. But this is another ABCD pattern in a bear market. This is actually the first Gartley pattern that we have here from the sell side. And Gartley said on page 221 and 222 of the book, whenever you have an ABCD pattern after in the start of a new bear market, ABC and the bull side of the new bull market, you should take that trade because that offers the best risk reward of any trades along that time frame. So you want to watch this very closely here at the 530 level in Chipotle Mexican Grill, because that is completing an ABCD at the 38% retracement. So we'll watch it over the next few days to see what happens, and we'll go from there. As far as the S&P, as long as we stay below that 207, the high that was made Friday, we're about 20 points under that right now. And as long as we stay below that, it looks like we have bearishness coming to the downside for all the reasons that we talked about on this show to begin with. And so we'll keep a very, very close eye on that. As far as the Treasury bonds go, we've also completed an ABCD pattern in the Treasury bonds, which makes them actually a candidate to be bought. So live every day in an attitude of gratitude, and may God bless.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.